You could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, the Home Equity Conversion Mortgage Program, part 2 of our series on the HECM Retirement Strategies with mortgage broker John Mangels, all here on Let's Get Down to Business. Welcome to the second segment, John.
Thank you, Steve.
Well, John, we kind of gave him a little bit of an introduction for seniors, Social Security, Medicare, and now the HECM strategies, all for seniors.
Correct.
Now let's break out some of the mechanics behind the scene. People say to me, Steve, I went out to look at what you were talking about on the show, and you said something about HUD. What does HUD stand for? What do they mean? Why are they even involved?
Well, the idea of HUD is to provide housing for everybody. So if you don't fall within the certain underwriting guidelines, it loosens up the guidelines and allows people that wouldn't normally qualify for a mortgage to get into a house. And so the idea is to provide home ownership for all Americans.
Now, the secretary, I forgot his...
Ben Carson.
Dr. Ben Carson now. So I'm sure he'll be benevolent and also watch the purse strings at the same time.
Oh yeah, well we'll see. So this is his first endeavor in the housing industry or mortgage industry.
Insured by the FHA. Now, there's a couple of things here. Well, first of all, who are they and why do I need this kind of insurance?
Well, the FHA, what they're doing by loosening the underwriting guidelines, they're saying they're backing up the lenders. So they're saying, please loosen up the guidelines. If these mortgages go into default, we will back up you and make you whole on the mortgage if there's a default and a deficiency. So by having the FHA mortgage insurance, it allows the lenders to create broader guidelines, underwriting guidelines, and potentially help people that wouldn't normally qualify for a mortgage get a mortgage.
Now, in this scenario for FHA, are we paying for, in a non-HECM scenario where we're not using the home equity conversion, is there an actually insurance premium you're paying?
There is. So there's two, actually. So there's an upfront mortgage insurance premium, and then there's a monthly mortgage insurance premium.
So they loosen it up. The down payment might be less, but you're paying premium for that.
Yes, and the FHA rates are a little bit less than they are on a conventional mortgage. So initially it looks like you're getting a lower rate on an FHA product, but when you add in the mortgage insurance premium, it actually ends up being a little bit more expensive.
Now, both the HUD, their oversight, and the insurance, FHA, covers this senior program, home equity conversion mortgage.
That's correct.
Okay,
yes.
Okay. So this is a government program only for seniors. Somebody in your household, man or wife, married, whatever, I have to have one person that's 62.
That's correct.
Okay. So even if the second person is 58 or 50 years old, as long
as one of the borrowers is 62, you can have a co-borrower less than 62. When they're factoring in how much you qualify for, they will always go off the lower of the two ages.
In that, there's three different, there's a lot of categories to this, but I want to talk about the big three. Let's talk about the first one, tax-free income. Well, it's not really income. It's not really revenue. It's not 1040 gross income. It's really an equity loan.
That's correct, yes. So you're just pulling equity out of your house.
So I could eliminate my mortgage and have tax-free income coming into me for the rest of my life if I wanted to.
That's correct. So there's a number of different ways that it works, but you could either get a lump sum distribution, you could have a line of credit where you could just pull cash out as you need. You can go on tenured payments where they say, okay, well, we'll pay you $500 a month for the next 25 years. You could say, well, I only need income for 10 years, so they'll give you $1,000 per month for 10 years. So there's a number of different payout strategies and options that you can choose from, and then you just need to work with advisors and figure out what the best strategy is for you.
Now, when we were off camera, you were talking about how many people of your clients, and you have thousands of clients over the years, they're actually taking their Social Security at 62.
That's correct.
So their Social Security is already online. And if they have any other reportable income, that could cost their Social Security, but not this.
Correct, yeah. So when you use a HECM mortgage, that cash that you're pulling out, whether it's in a lump sum or a monthly distribution, is for the most part, tax-free. It's pulling equity out of your house.
Okay, so really, if that's all I had, if I was really in the lower middle class and all I had was my home equity and my Social Security, I might be able to, with proper deductions and exemptions on my Social Security side, I might be able to take both out free.
That's true, yes.
That would be huge. Okay, so, and I love what you said. You can do it for a lump sum. You could do it for lifetime. You could even mitigate it in 10 years certain, 15 years, 20 years certain. You could pick a time period.
And you can change, other than the lump sum, I mean, you can change the distribution of the proceeds from the loan as your situation changes as well.
All right, purchasing a home. Nobody wants to take a mortgage into retirement. This is one reason why HECM is such a strong program. But purchasing a home, people are like, hey, I had a rough 2008.
Yeah.
Now you're telling me I can buy a home. In the first segment, we just gave a little touch and an introduction to this. When we're looking at the older you are, it's age determinant. So if I'm 62, and I thought, what did you say the maximum HECM was for value?
$636,150.
Which is a lot.
Yeah.
I looked up just before we came on the air, what is the 62-year-old by yourself? The worst, pretty much the worst scenario. It was about $308,000 on a $636,000, and you are done. You still have a mortgage, but you do not have a mortgage payment. Now, John, here's one of the things that people get in trouble with, and this is why you see all the bad boy stuff on the internet. They don't pay their property taxes.
That's correct. So you don't have a mortgage payment, as we say, but you still have to pay your property taxes, your homeowners insurance, your HOA fees, and then you also have to keep your house in good repair. So if there's a problem with the roof, you have to fix the roof. I mean, this is kind of just normal homeownership type stuff.
Now, this last one, we mentioned it just a short time ago, appreciating equity line of credit. I see so many applications, but the biggest one is my ultimate resource when everything else expires. Maybe I burned through my 401k. Maybe I have my Social Security, but I haven't had any cost of living over the years. Maybe I need to fix the house. Maybe I need to get into geriatric living. I don't want to go to a nursing home. I want to stay there.
Yeah.
I need to fix the house. I put the walk-in bathtub or whatever. I could actually take an equity line of credit.
You can, and so and one of the amazing things about this is you can pull out cash just like you would on a regular home equity line of credit. But there's a couple features of this one that are amazing, really. And one is the available credit appreciates by whatever your interest rate is on your HECM. So if it's 6%, your available credit actually compounds at 6% every year. So if you had a $100,000 line of credit year one, at the end of year one, your available credit would actually be $106,000. And that keeps escalating. So if you're not using your HECM line of credit, your available credit is growing, which is an incredible financial planning tool.
So remember, again, this is all equity line. It's all loans. If I take tax-free income, do I have to pay back?
No.
If I buy a home, do I have to pay back the money that I'm taking on a loan for? I mean, I can't believe I don't have an actual position that I have to pay back. These are all loans.
That's correct. So this is the ultimate. We've all heard negative amortization. Well, this is the ultimate neg-am loan. So yeah, you do have to pay it back, but it's not until you either move out of that house or you've deceased.
Now, I noticed one thing I just want to touch on this is you could do a combination of purchasing a home and buying an appreciating line of credit at the same time when you're going to purchase the home. And that could be something that could really recapture some of your closing costs.
Absolutely, yeah. So if you've put enough money down, you then have an available line of credit that is appreciating, as we mentioned, and it's a great way to recover your closing costs. So if your closing costs were $6,000, you had a $100,000 line of credit, at the end of year one, you could pull out the $6,000 and you've now whole.
You don't have to wait a year.
No, you don't have to wait a year, but that initial growth
would be after you want your years of interest.
Yes.
Okay, so tax-free income. We're going to break all this out in the next three segments. We're going to purchase a home, appreciating a line of credit, which is way different than the traditional HELOC. We'll get into that in the fifth segment. And you could do a combination of purchase a home and have an appreciating line of credit.
Yes.
Wow. Well, listen, don't forget to watch our next segment on tax-free income under HECM, part 3 of our series on the HECM retirement strategies. And keep in mind, before moving forward with any of the ideas on the show, always check with your tax consultant, legal counsel, or compliance officer. And don't forget to subscribe to my consumer show, Steve Savant's Money, the name of the game. Daily content you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.